debenture, whether it is a face value that is normal value or at par value. Value of the debenture will be included in the document. Rate of interest, what is the rate of interest that we are paying? Periodicity of the payment, how regularly we are going to pay the interest. Tenure of the debenture, how long the debenture will have. Terms of redemption, if there is a redemption, what are the terms of that particular redemption? Usually they are issued under the common seal of the company, because the company has got a one common seal. Under the common seal only we are going to get the debentures. Now when we are going to study about the debentures, we come with a few of the terms. We come across with a few of the terms. One is bond. Bond, like debenture, it is also an instrument of debt. It is also a debt instrument. Debentures is also a debt instrument. Bond is also a debt instrument. And debenture stock. Generally, individual debenture certificates are issued. For instance, a single debenture may be issued to one person. Sometimes a company create one loan fund. Debenture stock means either to a individual, a debentures will be issued. That we will call it as individual debenture, or a group of persons to whom the debenture stock will be issued. That is having a kind of a loan fund, we can say it as. So individual person can take the debentures, or it could be a group of persons who intended to have a loan fund. So like that, it is bond and debenture stock. Now, when we see the debenture and debenture stock, the difference is debenture is a description of an instrument. It is a description of a debt. Stock is a description of a debt. Debenture, because here we have only debenture, it is a description of instrument, what that instrument is. Each debenture may create a separate charge, whereas in debenture stock, charge is created by the trust deed, because here more than one person will be there. Hence, there should be a trust deed, whereas in debentures, because it is individual, it will be a separate charge created to that particular debenture holder. Debenture is transferable in its entirely. Transfer in parts may not be possible. Debenture stock may not be transferable in parts if articles permits. Now, debentures, we can transfer completely, but half of the debenture cannot be transferable. Whereas debenture stock, it can be transferable in parts if it is mentioned in the articles of association. A debenture may be either fully or partly paid, whereas a debenture stock must be fully paid. It should be fully paid, it should be fully or partly paid can be possible. Debenture is always for a fixed sum. That is, debenture's amount is always going to be a fixed amount, whereas debenture stock, it is not going to be fixed, but may of any amount. It can be of any amount, but it is not a fixed amount, whereas debenture is a fixed amount. Then we have types of debentures. Types of debentures we can study from the different perspectives based on the security, redemption, records, priority, and convertibility. Now, first we will see from the security viewpoint. From the security viewpoint, there are two categories for the debentures. One is secured debentures and the other one is unsecured debentures. Secured debentures, when debentures are secured either by a fixed charge or by a floating charge. Fixed and floating, the amount is going to be fixed and the amount is going to be fluctuating. That is fixed charge and floating charge. On the property of the company, they are called as mortgage or secured debentures. Secured debentures means basically if we know whether we are going to have a fixed charge or a floating charge, then it comes under your secured debentures because we have the complete information about it. Whereas unsecured debentures, when debentures are issued without any charge or security, they are called unsecured or naked debentures. They have no security. They do not enjoy any special rights. If security is there, the parties can enjoy rights. We call it as a mortgage or secured debentures. If security is not provided, then we can, because there is no security, they cannot enjoy any special benefits. So such debentures, we call it as unsecured or naked debentures. Then these are the two types of debentures from the security viewpoint. And then for the records viewpoint, we have registered debentures, bearer debentures. Registered debentures means name, address, and the required particulars of the holders of this kind of debentures are entered in a register or known as debenture ledger. This register is maintained by the registrar. These are transferable, but transfer requires execution of the transfer deed. When the debenture holders complete details are registered in the registrar, then we call it as registered debentures because their complete details are registered with the organization. At any time, if there is a transfer is possible, the transfer can be done with the help of the transfer deed in the registered debenture holders. Whereas bearer debentures, there is no need to get registered and company does not maintain any records. Bearer debentures, they don't require to maintain any, organization will not maintain any records on the name of the debenture holders, bearer debenture holders, and they need not have to register with the company. They can be transferable easily by mere delivery like negotiable instrument. From one person to other person, easily they can transfer without taking the permission from the organization or the company. And the interest and the principal amount of these debentures shall be payable upon presentation and delivery of the coupons and the debentures. The interest amount and the principal amount, once the closure, transfer or the closure of the debentures takes place, automatically the amounts can be transferred from one party to the another party. So these are the bearer debentures. Registered, it is basically like you have to get registered in that particular registrar or the company. Bearer registration is not required. Remaining everything is a normal thing which the debenture holders can go through with. So these are the two types of debentures with regarding to the records viewpoint. Then another type of debentures we have from redemption point of view, redeemable, irredeemable. The debentures are to be repaid by the company at the end of the specified period. It is repaid during the existence of the company. And if the payment is done at the end of the specified period, through when the company is existing in the market, we call it as redeemable debentures because it is repaid by the company. Whereas irredeemable, these are not repayable during the lifetime of the company. Once you have taken irredeemable debentures, and if your tenure of the debentures is completed, maybe some 2 years completed, again you cannot go for the repayable of the renewable of the debentures again. Whereas redeemable, it can be repaid by the company throughout a specified period till the existence of the company. Till the company exists in the market, till that period, redeemable can be repaid at any point of time. Whereas irredeemable cannot be repaid. They are perpetual. Perpetual in the sense they are having a particular tenure closure time which are perpetual in nature. When the company is wound up, these will be repaid. Automatically, when the company closes, the irredeemable debentures will be repaid. So these are the redeemable and irredeemable viewpoint. Then from the priority viewpoint, first debentures, second debentures. First debentures will be repaid before and prior to other debentures. They have priority over others. Second debentures will be repaid only after the first debentures are redeemed. It is something like ranking system, rank 1, rank 2 kind of a thing. First rank 1, first debentures will get all the benefits. Then the company go to the second debentures. So from the priority viewpoint, we have first debentures and second debentures. Then from the convertibility point of view, we have convertible, non-convertible debentures. Now convertible debentures can be converted into equity or preference shares. We call it as convertible debentures. And the debentures which cannot be converted into equity and preference shares, we call it as non-convertible debentures. And in the convertible debentures, we have partly convertible, fully convertible. That means a part of the debentures we can convert into equity shares or preference shares, and a part of will be remaining as it is as a debentures, whereas fully convertible, we don't remain with any of the debentures. We convert the entire debentures into equity shares or preference shares. These are the convertibility viewpoint view, that is convertible debentures and non-convertible debentures. Then the difference is not that much important, yeah. Now, the difference between shares and debenture is very important question which you have to know the differences between shares and debentures. Now, first, as per the status point of view, debenture holder is a lender because he is giving loan to the company. So he is just a lender or a loan credit or of a company. Whereas shareholder is a joint owner of the company. We usually call the equity shareholders are the owners of the company, right? So hence, shareholder is a joint owner of the organization, whereas debenture holder is merely a lender to the organization. Income perspective, debenture holders will get interest on debentures, which is going to be a fixed one and which is going to be predetermined one, which is fixed before only issuing the debentures. Whereas shareholders are entitled to receive dividend only when the company earns profits. So shareholders will receive only dividends when company earns profits. Whereas debenture holders, irrespective of the oh sorry, dividends debenture holders will get interest on debentures, whereas shareholders will get dividend on shares, which is not fixed. Interest is fixed to the debenture holders. Dividend is not fixed to the shareholders. Then income payable to shareholders. Debenture holders will receive the interest irrespective of whether the company makes profits or loss. Even if company is in losses, still the debenture holders should receive their income. That is their interest. Whereas shareholders will receive dividend only when the company earns profits. When they earn losses, shareholders will not get anything. Only when company receives profits, shareholders will receive the dividends. Nature with respect to profit. Interest on debentures is a charge against the profit. So irrespective of the profit, debentures interest is a fixed one. Whereas dividend on shares is an appropriation of the profit. That is, dividends will be issued only after we get the profits, right? So based on the appropriation of the profit only, we issue the dividends, we give the dividends to the shareholders. So interest is nowhere related with the profits, whereas dividend is related with the profits. Refund. A debenture holder gets back amount date of the maturity. Suppose a debenture holder is having a debenture for 1 year. Once the 1 year period is completed, debenture holder will get the lump sum total amount of debentures on the date of the maturity, whereas shareholder may not be able to get the money back on the shares. Shareholders, because they are the owners of the company, they are running the organization, they own the organization. Hence, there is no question of getting the money back from the organization, because as long as the company is there, shareholders will be there with the company. Safety. Debentures are secured. Shares are unsecured. Shares are unsecured. Debentures are secured one. Voting rights. Debenture holders has no voting right because they are the debt instruments. They are the small shareholders, we say. Hence, they don't get any voting rights. And shareholders has the voting rights. They are the owners of the organization. Hence, they will get the voting rights and decision making process. Shareholders involved in the decision making process of the company, whereas debenture holders will not involve in the decision making process of the company. Then discount on issue. Debentures can be issued at a discount. There is no legal restrictions. No need of taking permissions from any authority, any kind of, restrictions are there. If the company decides to issue debentures at a discount, they can issue the debentures at a discount. Whereas shares can be issued at a discount also, but subject to the provision of Section 79. Section 79 of Companies Act specifies a special regulation with regarding to the shares issued at a discount. So when the company decides to issue the shares at a discounted value, they have to go through with this particular provision mentioned in the Section 79 of Companies Act. Purchase its own debenture shares. The company can purchase the own debentures without any legal restrictions. Suppose I have a company, I have issued debentures to you. I have complete right. Again, I can buy it back from you people. Debentures, I can buy it back. So that is, the company can purchase its own debentures without any legal restrictions, whereas a company cannot purchase its own shares. Own shares cannot be purchased by the organization, but own debentures can be purchased by the organization. Now, at the time of closing up, winding up, who will be given first priority, debenture holder or shareholder? I'll give you an example. Suppose we have conducted what we can say, we have conducted a function at our home and we invite our guests, relatives, everyone. At the time of serving the food, will we go sit and eat first or will we serve to our guest? Obviously, we serve to our guest. Hence, shareholders are the owners of the organization. Debenture holders are the outsiders of the organization. When I'm closing my business and when I am distributing the amounts to the concerned parties, whom will I give the amount first? Will I give the amount to the owners or will I give the amount to the outsiders? We have to give amount to the outsiders. So a debenture holder gets priority in respect of repayment when the company is wound up, when the company is closing, and when the company decides to pay the clear all the debts. First, debenture holder will get priority more than the shareholder. Shareholder will get back their money only after settlement of all other claims, because they are the owners. Shareholders will receive the money at the end after clearing the debts of all other parties. Shareholders will get the money at the end of the clearing debts to all other parties. This is the priority. When we see the priority wise, debenture holders gets the priority in respect of repayment, whereas shareholders will get the money, but not on a priority basis, but on the last service basis. These are the differences between debentures and shares. Yeah, let me share another screen with you all. Now let us see a problem based on the issue of debentures. In the previous class, we have seen the issue of shares, right? Issue of shares, issue of debentures almost have the same category of, journal entry, preparation or calculation. The only difference is we are issuing at a premium or we are issuing at a discount. That the differences will be there, and here interest rate will be there. That you must be careful. Now, A Limited issued 1,012% debentures. 1,000 is number of debentures. 12% is interest rate of debentures. 10 rupees is the face value, that is the par value of the debentures. So, company is issuing 1,000 debentures. Interest payable is 12% and 10 rupees each is the debenture price, debenture value, each debenture value. Give the journal entries under two situations. If the same debenture are issued at a premium of 6%, issued at a premium of 10%. Now, if you see, the journal entry will be bank account data to 12% debentures account to debenture premium account. As I told you, when we are issuing debentures or shares, when you are issuing at a premium, at a discount, no matter you issue at a premium, you issue at a discount, you have to mention separately what is the premium amount, what is the debentures amount. Okay. Now, in this problem, if you see 1,000 shares, 10 rupees each, issued at a premium of 6%, they have mentioned. 6% means you have to take 1,000 into, 10 rupees into 6% you have to take. Okay. Then 12% debentures, bank account data 11,000, to 12% debentures 10,000, then debenture premium account 1,000. This is how you entered the debentures at a premium of 6%, then the debentures at a premium of 10%. 6% and 10% premium. Here, if you see, it is very much clear. Then issue for consideration. X Limited acquired. Issue for consideration. Consideration here we mean something in return. As I told you in the previous class. Here, X Limited acquired assets of 5 lakhs and took over the liabilities amounted to 50,000. So, X Limited has taken 5 lakhs assets and liabilities are worth of 50,000 at an agreed value of 4 lakhs. Y Limited issued 12% debentures at a discount of 20, full satisfaction of the purchase price. The assets I have taken is 5 lakhs. The liabilities I have to pay is 50,000. 5 lakhs, 50,000. And I am agreeing to take the assets at 4 lakhs. That is, purchase consideration is your 4 lakhs. So for same thing, if you enter the journal entries, sundry assets account data, we have taken 5 lakhs. Two sundry liabilities, 50,000 is a liability. Then two Y Limited, that is 4 lakhs is a purchase consideration, which we are giving to Y Limited. So Y Limited account data, 4 lakhs. If you see 5 lakhs minus 50,000 minus 4 lakhs, balance you will get is 50,000. That is nothing but your capital reserve. Here, because assets are more, you will get capital reserve. If your liabilities are more, you will get goodwill. Next, this 4 lakhs, they are issuing in terms of the, this 5 lakh asset value, they are issuing in terms of the discount on debentures. So, Y Limited account data 4 lakhs, that is purchase consideration. Discount on debentures is 1 lakh, that is nothing but your 20% of discount. That is 5 lakhs into 20%, it comes to 1 lakh. So discount on debentures is 1 lakh. Two 12% debentures. Total debentures value is 4 lakhs plus 1 lakh is 5 lakhs. This is for the issue of, we are issuing the debentures for a consideration, that is against the purchase consideration. Now, this is another type of situation where it is on a particular condition. Like C Limited issued 1,012% debentures of 100 each. Give journal entries under two conditions. Issued at par and redeemable at par. This is redemption of debentures. Issued at par, redeemable at par. And B situation, B bit is issued at a discount and redeemable at a premium. Now, first situation we will see issued at par. That is bank account data to 12% debentures account. 1,000 into 100, it comes to 1 lakh. Now uh, same for B bit bank account data, we are issuing at a discount, right? So 1 lakh into 10% is 10,000. 1 lakh minus 10,000 is 90,000. So bank account data 90,000. Discount on debentures is 10,000. Loss on issue of debentures is 10,000. Two debentures, we have 1 lakh. We are issuing at a premium of 10%. Same 1 lakh into 10%, 10,000. In the second bit, it so happened that we are increasing the price, we are decreasing the price. So this 10,000 and 10,000 will get cancelled. So hence we have a loss on issue of debentures of 10,000. So this is how we have a discount and redeemed at a premium, both at a time given in a problem. Hence, premium should be credited, discount should be debited. So premium minus your discount, if you do, you will get loss on debentures. If your discounted value is not there, then you will get profit, but your discounted value is there, hence you got loss on issue of debentures. This is how the issue based on the condition. Now there is one more question. On 1st January 2007, a company issued 2 lakhs 14% debentures at 5% discount repayable in 5 years at par. So it is 5 years repayable, that is redeemable debentures. The interest is repayable half yearly 30th June, 31st December and the same way duly paid. So half yearly interest is payable, that is 6 months. Every 6 months they are going to get the interest amount. On 31st December 2007, company purchased 20,000 debentures at a cost of 18,900. We have to enter the journal entries. First, we will see the journal entries. 2 lakhs rupees of debentures, 5% is the in discount. So, bank account data, discount on debentures. On 2 lakhs, if you take 20%, it is 10,000. So 2 lakhs minus 10,000 is 1,90,000 only, because we are issuing at a discount. So 10,000 will be deducted, 1,90,000 you will have in your account. So bank account data are 1,90,000. As I mentioned, your discount will be debited. So discount account data are 10,000. Debentures account data 2 lakhs. Now, once the debentures are issued, on 30th June, we will receive the interest every 6 months. So interest on debentures account data to bank account. The interest is how much? Interest is 14 percentage they have mentioned. This is nothing but your interest. Interest is 14 percentage. Hence, 2 lakhs into 2 lakhs into 14 percentage. No, no. Let me. Yeah. 2 lakhs into 14 percentage will comes to 28,000. But we are not paying per year, right? We are paying per month. So 28,000 into 6 divided by 12 if you do, you will get 14,000. This is half yearly interest. Again for 2007, December, again they will get the interest. So interest on debentures account data to bank account, same 14,000. So 14,000, 14,000, total 28,000. This is for 1 year it is completed. Now, after 1 year it is completed, we will transfer the interest to the profit and loss account. So, profit and loss account data to interest on debentures. As I told you, total is 28,000. When you divide this between two equal halves, 28,000 divided by 2 is 14,000 and 14,000. Now, in the same year, we have purchased a few more debentures. So, to bank account 18,900. To profit on redemption of debentures is 100. Actual value is 20,000. Hence, we have reduced it value to 100. The 100 is the profit on redemption of the debentures. Then the same profit we need to transfer it. So, profit and loss appropriation account data to debenture redemption reserve, that is 20,000. Then a profit on redemption of debentures account to capital reserve, that is same 1,100, we have transferred it. This is how the issue of redemption of debentures will take place. This is your entire block 1, which we have dealt in the previous 3 classes. Block 1, chapter 1, you have issue of share capital. Chapter 2, you have acquisition and profits prior to incorporation. And chapter 3, the one which we have discussed right now, that is issue of debentures and redemption of debentures. Now, next you have block 2, that is company final accounts. Company final accounts, if you remember, company final accounts, uh, the final accounts which you have prepared in your advanced accounting, the same way of company final accounts we are going to prepare, but the format has changed. The format has changed. The preparation, we will prepare the same trading P&L account balance sheet, but the preparation format has changed. Now let us see that preparation format. Just a minute. Right, let me share a screen. Right, this is the final accounts. The final accounts which you have studied in your previous semester, that is the presentation format has changed, but the calculation part almost it is similar only, except for few of the items and updated items that have been changed. Okay. So I'm not going to explain all the, partnership difference, company accounts difference, because you already have it. I'm going to explain you with regarding to the maintenance of the profit and loss account and Right, if you can see here, this is the format of a P&L account which we will follow here. That usually in P&L account, what we will do, we will take a T format where the credit side we will take the incomes and the debit side we will take the expenses, right? But here, in case of the new format, we start with we start with revenue items first. Like if suppose this is the problem that is given to you in the question, like all the trial balance is given and some adjustments are given, and we usually follow this method, right? T format method, that is credits and debit method we will follow. But now in the new updated format, we are not going to follow the same T format. We are going to follow a different format. Let me also check it in your textbook. Okay. In block 2, you have final accounts 1 and final accounts 2. In final accounts 1, you have everything with regarding to the financial statements, preparation of final accounts, how we will prepare the final accounts, and the various sections that has been mentioned in your textbook. And provisions pertaining to the company profit and loss account, that is how we are going to prepare the profit and loss account. With respect to the revenues, first we have sale of product in page number 69, you can see it, ma. Uh, In respect of a company other than the finance company, revenue from operations shall be disclosed separately in the notes. Revenue from sale of the products, sale of services, other operating revenues. If any excise duty is there or if any interest is there, that we have to deduct it. And the second bit we have is finance cost, which includes all types of interest, any other borrowing cost, or any applicable rent or any net gain or loss that we have to take it here. Then fourth one comes to your other income, any other sorts of income that we have to take it here. And after fourth section, we have fifth one, additional information with regarding to first one is your employee benefits, whatever the benefits that employee is receiving from the company. Usually employee receives a salary or any sort of incentives they can receive, so that will be entered in the employee benefit expenses. And then we have expenditures with regarding to the debentures, consumption, power and fuel, rent, repairs, insurance, taxes, and any other miscellaneous expenditure we will take. Then we have something called cost of producing activities, cost of production activities, which includes raw material, components, and capital goods. We have a pro forma with regarding to this in 73. Page number 73, if you can see the pro forma which is there in your textbook, page number 73. There, if you see, first section, we are writing revenue from operations. That is, revenue from operations is nothing but your income. We get revenue. Revenue is nothing but income, right? We get income from different sources like sales or any other source. We take revenue from operations. Second one, other income, which doesn't comes under the revenue. We have to enter it in the other income. Then it will become your total revenue. That is total of incomes, which comes after you add first section and second section. And the fourth section is your expenses, which is further divided into cost of materials consumed. That is opening stock, purchases, closing stock, all comes under cost of material consumed, which here it is mentioned purchase of stock in trade, changes in inventory. Changes in inventory here we mean opening stock, closing stock minus opening stock, we will do the same thing. Then employee benefit expenses, which includes your salary or any other benefits given to the employees. Finance cost includes your depreciation, any interest payables, all those expenses we will enter here. The expenses which doesn't fall under any other category, which we have to take it under other expenses, which are like general expenses, rent, insurance, printing, stationery, fuel, gas, all this comes under your other expenses. Once you have entered all the expenses, take the total of your expenses. Now, after that, you calculate the profit. That is nothing but your total revenue minus total expenditure. That is section 3 minus section 5. You will get the profits prior to tax, profit before tax. Then after that, you have to take profit taxation. After deducting the tax, you will get the profit after tax. The remaining everything is not required for us. You remember only one thing when you are preparing the profit and loss account. We don't call it as a profit and loss account actually, statement of profit and loss account in the new format. Okay. First, we take revenue from operations, which is nothing but your incomes. Then other income. Add these two, you will get total income. Then third one is your expenses. Take all the expenses under the heads. Now, total of your expenditure. Now, total of your income minus total of your expenditure is profit before tax. Then you take tax, deduct tax, you will get profit after tax. This is a statement of profit and loss account, which will refer it now. Then after P&L account, then comes the balance sheet pro forma that is there in your page number 83. That is balance sheet pro forma. Where if you see balance sheet, usually how we have to do, how we have done like a T format where you have liabilities and assets, right? But here it is not like that. First we will take liabilities, then we will take the assets. So the format is changed. If you can see here, first section is your equity and liabilities. Under the first one is shareholder funds, in which you have to write the share capital. Any reserves and surplus. Reserves and surplus here we mean general reserve. And surplus here we mean the profit which we got it in the P&L. Then third bit is money received against share warrants. Share warrants is a different thing. If the share warrants are given in the question, we have to write the share warrants in the this particular column. That will be your first point. Second point, share application money pending allotment. Any application money is pending for allotment, that we have to take it here. Then third section, you have non-current liabilities. Non-current liabilities, you will have long-term borrowings, deferred tax liability, that is provision for taxation. Other long-term liabilities, long-term provisions, all that we will write. Long-term items, we will write it in this particular column. Then fourth one is current liabilities. All the current liabilities, we will write it here. Then we will take the total of liabilities column. Now, after that, we go with the second head, that is assets. Assets are divided into non-current assets, current assets. Again, non-current is divided into fixed assets. In the fixed assets, again, we have tangible, intangible, work in progress, intangible assets under development. Then non-current investments, deferred tax assets, long-term loans and advances, any other non-current assets. Then when it comes to current assets, it is inventories. Current inventory is closing stock, that is a stock. Trade receivables is nothing but your debtors. Cash and cash equivalents, that is cash in hand, cash at bank, and short-term loans and advances and any other current assets. Then after you enter all the assets, you take the total of your assets. Your total of assets should tally with your total of assets, hence your balance sheet will get tallied. So this is the pro forma we follow when preparing the final accounts in the new form, final accounts of the new format. Now for the same thing, if you see page number 97, page number 97, 97 and 98, there you have a profit and loss account pro forma given to you. As I mentioned you, first section you have revenue from operations. Here in the pro forma, two account columns are provided. One can be treated as the inner column, the outer one can be treated as the outer column. So inner and outer column. So first one is your revenue from operations, all the, revenue from operations. In page number 99, you can see third bit, revenue from operations includes sale of the product, sale value, sale of services, or any other operating revenues. Then next we have other incomes. Any income which is not intended to be referred under revenue from operations will come under other income. Now, after you take other income and revenue from operations 1 and 2, third one you are going to add both 1 and 2. That will become your total of incomes or total of revenues. Then the fourth one you have expenses. As I mentioned you, under expenses we have particular heads. Cost of materials, that is opening stock, purchases, closing stock, that you have to write. Then employee benefit expenses, employee salaries, all the benefits received by the employee. Then finance cost includes your interest on loan, interest on debentures, all interest amount we will write it in the finance cost. Then you have depreciation on plant and machinery, depreciation on building, you have to write on a depreciation. Any other expenses which cannot come under the previous heads, like general expenses, printing, stationery, will come under other expenses. Once you have taken all the expenses, take the total of your expenses, that will become your 4. Then you calculate the profit or loss before the tax, which is nothing but your total income minus total expenditure. That is 3 minus 4. If you do, you will get profit before tax. Then if you deduct the tax, current tax or deferred tax, you will get profit after tax. This is the actual pro forma. And in page number 100, if you see, a problem is given to us. In page number 100, we have a problem with regarding to preparation of profit and loss account. That is, trial balance is given and some adjustments are given. Now, if you see the pro forma of P&L account, we are not mentioning profit and loss account. It is mentioned as statement of profit and loss. Even in the exam also, you have to mention the same way, that it is a statement of profit and loss, not the profit and loss account. Now, in the statement of profit, first we will take the income. Income, revenue from operations. We have only sales revenue from operations, that is 2,25,000. Same amount we have taken here. Then we have other income, because on the credit side we have discount given. So this discount is an income only. That means we received a discount. Discount received, it is a income. So we have taken as a discount as other income 14,000. So 2,25,000 plus 14,000 will become your 2,39,000. That is your total of incomes. Then we will take the expenses. Expenses as heads we have to take. First head is cost of goods sold. Cost of goods sold is nothing but purchases. Purchases value is 57,500 plus opening stock. Opening stock is 75,000 minus closing stock. Closing stock is given in the adjustment 95,000. So 57,500 plus 75,000 opening stock minus 95,000 closing stock given in the adjustment, you will get 37,500. Then employee benefit expenses. Which benefits we are giving to employees? One is wages we are giving, one is salaries. So take both amount, 30,000 and 4,000. That will become your 34,000. Then you have staff welfare expenses, 37,500. Along with that, in the adjustment, they have given outstanding staff welfare. After outstanding amounts, obviously we will add. So hence we have added 2,500. So 37,000 plus 2,500 plus 30,000 plus 4,000. Total comes to the 74,000. Then financial expenses, we don't have any financial expenses because no interest is given to us in the problem. Then other expenses. All other expenses like rent and sundry expenses. We have only two other expenses, rent and sundry expenses, 2,500, 4,500. Total 7,000 we have taken in the outer column. Then we have depreciation. In the adjustments, we have given depreciation for plant and machinery 20%. So 20% on plant and machinery. Plant and machinery is 15,000. 15,000 into 20%, it comes to 3,000. Then total of expenditure is nothing but your 37,500 plus 74,000 plus 7,000 plus 3,000 will comes to 1,21,500 total of expenditure. Now profit before tax. Total income is 2,39,000 minus total expenditure is 1,21,500 and the profit before tax is 1,17,500. And taxation is given to us in the problem. Third bit in the adjustment, have a provision for income tax at 50%. They are mentioning Provision for income tax at 50%. So minus provision for tax 50%. On which amount you have to do? On the same amount, 1,17,500 into 50%. If you do 58,750. If you deduct this 58,750 from 1,17,500, the same 58,750 will come as your net profit. So this is how we will prepare the statement of profit and loss account. The procedure, the presentation part is different, but other than that, the way we calculate the depreciation, the way we take the figures, everything is going to be the same. Only thing is now we are dividing the expenditure or the income based on a particular head. A head ki a head divide చేసి ఆ particular head లో మనం ఆ expenditure ని separate గా చూపించాల్సి వస్తుంది. అంతే తప్ప remaining everything final accounts is as it is. This is your statement of profit and loss account. Then we have balance sheet also. In the next class, I will explain you balance sheet and profit and loss account again. This is your today's explanation with regarding to issue of debentures and redemption of debentures and final accounts part 1 and part 2. In that profit and loss account, I have explained it today. Kalpana,
ఎస్ మ్యామ్.
నేను నీకు మెటీరియల్ పంపించానమ్మా, వచ్చిందా?
రాలేదు మేడం.
నేను నిన్నే పంపించాను, ఒకసారి చెక్ చెయ్యి. మళ్ళీ వేరేది కూడా పంపిస్తాను, చెక్ చేసి నాకు ఒకసారి మళ్ళీ మెయిల్ చెయ్యి.
ఓకే మ్యామ్.
వచ్చిందంటే చెప్పు, రాలేదు అంటే మళ్ళీ పంపిస్తాను.
ఓకే మ్యామ్.
ఓకే.
ఓకే.
Okay, then this is it for today's class. We will meet again in next class, that is tomorrow. Have a nice day. We'll meet again in the next class. Thank you.
థ్యాంక్ యూ మ్యామ్. బాయ్.